I know in multifamily, like usually I take the gross rents, I can say 50% expense ratio, just depending 40% to 60% expense ratio, just kind of depending on where you're at. Are there any rules of thumbs like that for the senior living communities?
When it comes down to that, the unit allocation at the property is really going to drive a lot of the underwriting. One thing that is heavily focused on in senior living that is maybe lightly touched on in multifamily is your operating margin. Because,
Now, for our viewers that don't know who you are, if you wouldn't mind just kind of giving a brief introduction, like who is Stuart Keller and how did you get involved in this wonderful world of investing in senior living communities?
Yeah, so really, I mean, kind of at a high level, career started out doing asset management, acquisitions, and underwriting for basically all asset types. It was in 2010, a lot of REO stuff. Worked for about 3.5 years for a smaller boutique private equity shop. Moved over into operations on the multifamily side as a regional manager, and then oversaw portfolios as a regional vice president. And then when I joined Lloyd Jones a little over 3 years ago, it was initially to be on their management side to oversee the management portfolio of about 7,000 units. About 4 months into that, I was actually tasked with building out and really solidifying our asset management platform. So I did that for about 2.5 years. Really learned all the nuts and bolts and all there was on the financial side, in addition to the operations side. And then about 90 days ago, almost 4 months ago, got tasked with building out a syndication platform, which will allow through Reg D 506C offerings, accredited investors to invest into our senior living properties, which we've actually been buying all cash off the balance sheet and then recapitalizing them via syndication or JV partnerships.
Love it. Love it. Love it. Now, for our viewers, like let's say somebody's been wanting to get into senior living communities, like what would you say is like the first step? Like where would I go and maybe find a senior living community? Do I just go like on LoopNet, on Crexy, on CoStar? What is the best way to kind of find some of these opportunities? And once I find it, like what do I look for?
Yeah, so having or partnering with somebody that's been doing senior living and understands the underwriting, what differentiates the senior living underwriting versus say a multifamily. There's a lot of symmetries and a lot of overlap. The one thing that you really start to identify as the fundamental differences is senior living communities have staffing requirements and staffing ratios. So finding effective operators that have done it are critical. Multifamily, you're dealing with, some amenities here and there. You're dealing with people's apartments. They might lease the apartment after looking at it online. When you go into a senior living community, you're talking about somebody's, care. There's meals, you have to provide, they live there 24/7. On the assisted living and the independent living, there's quite a bit more latitude, but there are still supportive care requirements as outlined by each state. So first off, knowing the state requirements on what that care looks like will help you understand the financial underwriting components of it. And then the other really big delineation between multifamily and senior living is, leasing an apartment multifamily, you might text, you might call, sign up pretty easily. For a senior living community, you're dealing with the sons, the daughters, and the family members of the resident. And you're talking about on average, maybe 10 to 12 interactions with any one resident or the family of a resident. So it's a much more personal, I guess, development and relationship in getting those, residents moved in. It's obviously going to be a major life move. They might be selling their house. So from an underwriting standpoint, being able to say, okay, is this model credible? if they have month one moving in 5 residents on a 90 unit property, you just throw that right out the window. Unless, of
Yeah.
course, like they've already confirmed their move in, they're already on track, they've already paid all their fees. You know, the lease up process is much lower, but the returns and the path to get there, I think, is what's really driving the market. And what's really we're on kind of the leading edge of just an absolute housing crisis when it comes to senior living. And that's why, you know, we're kind of going in feet first, like all in on the senior living side. So, back to your original question, I would say it's really about relationships,
Hmm.
and it's being able to partner with sponsors that have done this in the past, to be able to be awarded a deal.
Yeah, it's funny because I agree with you 100% that it's a growing area because obviously we've got so many baby boomers every day reaching an age where they're retiring or need additional care. It sounds like the underwriting is dependent on whether it's independent living. The numbers would be different if it was independent. It would be different if it was assisted living, and it would be different if it was memory care, because obviously there's different ratios that you have to look for because they're all going to require a different level of care. So it's not just like your standard. It also sounds like some of the challenges might be like, as opposed to an apartment complex, is going to be finding the right people to operate these types of buildings that
Yes.
understand how it basically works. So unlike an apartment where maybe you have an on-site property manager, over here you've got different people that are responsible for a lot more things than just like your average person. So are there any ratios? Like I know in multifamily, like usually I take the gross rents, I can say 50% expense ratio, just depending, 40% to 60% expense ratio, just kind of depending on where you're at. And then that gives you like the NOI. Then you obviously give it a cap rate. Are there any rules of thumbs like that for for the senior living communities, or any special ratios like, okay, staffing is about 30% of the gross rents, or anything like that that our viewers would be able to benefit from?
Yeah. So, when it comes down to that, the unit allocation at the property is really going to drive a lot of the underwriting. One
Mm,
thing that is heavily focused on in senior living that is maybe lightly touched on in multifamily is your operating margin.
mhm,
Because, so say on a 100 unit property, it's all assisted living.
mhm.
And this is just kind of hypothetical, but if you've got a, nursing care relative to the number of residents, it might be 5 to 1, 5 residents for every one, full-time nurse or somebody.
Mhm.
Um, you get that one extra unit from 80 units to 81 units. You have to bring on another full-time person. So your operating margin is going to go down. So you're
Big
actually
time.
going to be losing money by getting the one more resident. Now, the way to optimize this is figuring out and identifying properties that have a good, ratio of IL, AL, and memory care. Or maybe it's just all IL, or maybe it's just all AL. But typically, when you're identifying an asset, having a mix is gonna allow you to retain those residents for continuance of care. So you might have some residents that are IL that maybe they've developed some cognitive, you know, deficiencies. Maybe they're going to be moved over into the the AL portion. Now their rents are going to go up, the level of care is going to go up, and then your operating expenses are going to go up, but it's going to be able to provide that continuity. Then you're going to go from an assisted living to a memory care. So, somebody who enters assisted living might be, you know, doing really well, but only showing minor signs of cognitive decline. And then after a year of living there, they'd be moved over to the memory care facility.